Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So let's dive a little bit deeper into the Nvidia earnings. Who do you want to dive deeper in than Dan Ives?
No better person right now.
That's our guy. I mean, he's getting geared up for Penn State, Nevada this weekend.
Oh, yeah.
But he's probably focusing a little bit here on Nvidia. Hey, Dan, I thought these numbers were darn good, but I know there's the law of large numbers. I know there's a whole thing about expectations. Give us your take on these Nvidia numbers, Dan.
I thought they were robust. And I think to some extent, when you factor China in, they actually beat expectations, especially when you look at the outlook. I think this is a stock that's up today. And I think it further validates what we obviously been talking a lot, with you and the team about the AI story now playing out into the next stage of growth. This is bullish, in my opinion.
Dan, what was your takeaway here as it relates to a lot of the spending here, CapEx?
I think it just shows there's one chip in the world fueling the AI revolution. It's led by Godfather of AI, Jensen Nvidia. And you look what's happened on CapEx, it's just continuing to accelerate. And then you factor in China, that could be 50 billion. I mean, and Jen's talking about the 50% growth. I think this is just now, it's showing the next phase of the AI revolution is now starting to play out, especially when you combine it with hyperscalers and everything we've seen from Palantir, now Snowflake, MongoDB. The use cases are expanding.
Dan, flesh out for us the whole China situation. Where is Nvidia today vis-a-vis China? And how do you think this is going to play out over the coming quarters with their H20 chip?
Yeah. Oh, look, they're caught in the middle between U.S. and China. But the reality is Jensen's 10% politician, 90% CEO. And Trump administration knows biggest chip on the poker table is Nvidia. So as this all plays out, it's a pay-for-play model. They're going to have access to China, even if it's restricted. And that's going to add an increment of what, 2, 5, 6 billion per quarter. And even though Beijing telling maybe these companies you don't want to buy Nvidia chips, that's like telling a kid not to eat candy. Big tech in China wants Nvidia chips.
So, I mean, as we dig in here into the data, what we saw from the earnings report, what is your takeaway in terms of what they were able to see specifically in terms of data center AI demand? That's definitely something that's been in focus here with this report.
Yeah, look, I think it's noise in terms of any quote unquote miss, because when you factor China, it's basically over 1.5 billion beat. They're seeing demand accelerate. I mean, no region is not showing acceleration. And now you're starting to factor in what's going to happen in the Middle East, what's going to happen in China, what's going to happen in the rest of the world. And you're really talking about one chip that's fueling it. So when I look at Nvidia, I think there's a $5 trillion market cap potentially by year end or early 26. And it's just further validation for the AI revolution thesis.
So talk to us, Dan, about their customer base and the concentration of their customers. And I know they want to broaden out their customer base, maybe to sovereigns and to other net buyers out there. How do you think that's going to evolve?
Well, big tech's going to continue to dominate as a quote unquote customer base in terms of the concentration. But now as sovereigns play out, as enterprises play out, you're going to see more and more people, obviously start to understand that this revolution is not just big tech. It's about other sort of regions starting to play. And there's only one chip in the world fueling it, and that's Nvidia.
So taking a step back here, Nvidia wrapped up all of the Mag 7 earnings here. What were your thoughts more broadly overall this earnings season?
I mean, I think this is a bullish tech earnings season. We've talked about it. The validation that the AI revolution hit its next stage of growth. It's spreading second, third, fourth derivatives. Now, granted, look, Nvidia is the Scotty Scheffler of tech, okay? But what you're starting to see now play out is those derivatives, the spending, the multiplier, it's all happening. And I think that's just bullish going into year end in terms of tech stocks. And I think this bull market has 2 to 3 year run still left.
Dan, so as you talk to institutional investors, how are they viewing this 15%, government fee that the U.S. government may impose on some of these chip sales to China? How's that being viewed by investors?
Look, it's unusual. It's a pay-for-play model. But guess what, investors? It's new rules of the road, right? Big tech's starting to understand how that works. But when it comes to Nvidia, okay, pay 15%. That's breadcrumbs. You could raise prices 15%. You need access to China. You can't give Huawei on a silver platter that market. So as it continues to play out, I think investors have accepted they want Nvidia open access to China because that continues to be the golden goose that Jensen's going after.
Dan, I want to quickly go right back to what we were talking about here when it relates to data centers. How concentrated is NVIDIA's revenue right now? Or the top 5 hyperscalers still the overwhelming majority of data center sales?
Look, it's concentrated, but that's just the nature right now. Big tech's 360 billion, but it's going to spread. Sovereigns, enterprises, rest of the world. NVIDIA is going to continue to own that. So concentrated today. But you look at 3, 4, 5 years ago, that concentration will continue, I think, to diminish as more players get into AI. But there's one chip fueling it, and it's NVIDIA.
Dan, how do you think about the competitive environment for NVIDIA here? Is it AMD? Is it Huawei? Is it others we don't know about at the moment?
Yeah. Look, Lisa's suing AMD, clearly competition. I think that we continue to be bullish on that in terms of getting more and more piece of the pie. Huawei is a competitor, but that's the whole reason that you don't want to just give them full access to China, because that will help them narrow the gap. We're bullish, obviously, on Broadcom and others. And I think, look, as this plays out, NVIDIA is years ahead of any other competition. And even when you hear talk about, U.S. government and obviously, SoftBank investing in Intel, I mean, Intel is, so many years behind. They continue to really have just a massive uphill battle. And that's why NVIDIA is top of the mountain.
All right, Dan, your Penn State Nittany Lions open the season Saturday, 3:30 p.m. on the CBS television network and Paramount Plus against Nevada, 43.5-point favorites. How do you feel about your Nittany Lions this year?
I mean, look, I was at practice last week, State College. I told you, I think this is the year. I think we win the Natty. We have some tough games, Oregon, Ohio State, but I think Big Ten continues to hold the mantle. I like Al Singleton and Penn State. I think we'll be holding the trophy in January.
I like the call. Nice and clear and confident. Dan Ives, Global Head of Technology at Wedbush Securities. We appreciate getting a few minutes of Dan's time here today on NVIDIA and Big Tech. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Anastasia Amoroso joins us, Chief Investment Strategist at Private Wealth at the firm's Partners Group. Anastasia, the market's been so fixated on AI, and then I guess NVIDIA is probably the poster child for AI. How do you think about that as a theme for the market? How important is that to you, the NVIDIAs of the world in this AI theme?
Sure. Well, obviously very important. And Paul, I am with you. I thought the NVIDIA numbers were just fine. It's really interesting that on the surface, investors were disappointed because NVIDIA, despite the fact that they beat and raised, they didn't meet the loftiest of expectations. Right. Of course, that probably makes sense because the stock has rallied as much as it has, I think over 100% since the bottom in April. So I thought the numbers were fine. And the AI theme is obviously hugely important. And I think NVIDIA highlights that it's still top of mind and front and center for investors. And I say that because, analysts focus on the growth rates that are tapering off, but consider the base. Consider the fact that AI hyperscalers are going to spend $400 billion in AI CapEx in 2026. This would be a number that was unthinkable about just a couple of years ago. So we're at a significantly higher scale, but what happens at that point, it's natural that some of those growth rates taper off. But for us, Paul, it's still AI is such an important theme. And I think NVIDIA results also highlight that there's so many other ways to access that, including in private markets, including in infrastructure. So that's what we're really focused on.
I mean, when we look at any sort of earnings report from NVIDIA, there's a lot of anticipation heading up to it. And we do see a lot of these lofty expectations, as you noted. Is there any concern that maybe, expectations are too high for some of these companies?
I mean, they've certainly been ratcheted up, but I will say that if you look at the history of NVIDIA, for example, it has a history of delivering on those expectations. And maybe on the exact earnings day, they don't always deliver on the loftiest of expectations. But what you see over time is the price continued to march higher because the expectations have continued to march higher. So I think that's something that supported the stock and probably will continue. And look, broadly speaking, if I think about is AI meeting expectations, I think it is for what it is today. We are starting to see some early signs of monetization, and you can think about it in terms of a couple of pockets. You can think about it in terms of cost reductions, in terms of productivity improvements, and also in terms of actual new revenue streams. And I think the actual new revenue streams maybe are a little bit further off for some companies, although I think we are starting to see more cloud. We're starting to see utilization. We're starting to see more social media success, for example, with our targeted ads. So I think you do have some positives in that revenue generation pocket, but you have more and more positives that companies are citing in terms of efficiency gains and in terms of cost reductions. And so that's why the momentum for us for AI is likely to continue, because there are tangible benefits that more and more companies can point to.
So what other ways are you suggesting that investors get exposure to AI? A lot of folks have been saying maybe like power generation or something like that. How do you think about that? Because not everybody is comfortable paying some of these technology multiples. And maybe a lot of folks think that some of these tech names, like the software names or maybe the hyperscalers, have kind of outrun their comfort level. So they're looking for other ways.
Right. Paul, I think the first thing investors have to do is take a giant step back and just size the opportunity set, right? A couple of years ago, the Gen AI total addressable market was somewhere around $200 billion. You fast forward to 2027, 2030, you're now looking close to $1 trillion TAM for artificial intelligence. So that means that it's not just NVIDIA and semiconductors, but it's a whole host of beneficiaries. And I would put them in two sorts of opportunities bucket. The first one I would say is in infrastructure. We have to build up the infrastructure to ensure that AI is possible. So what does that mean? That certainly means data centers, and not just any data center, but an AI specific data center, which requires more power density, which requires greater connectivity, which requires more cooling. So that's a big topic for us. The second one, as you mentioned, it's actually power generation. You can't really run that data center without the power. And if you think about the power consumption, it's for some of these things, it's approaching 1 gigawatt. That's what we're talking about here. The third component, which is not as well talked about, I would say, is actually fiber and all sorts of wireless connectivity. It's one thing to train AI in a data center, let's say in the middle of the country without a proximity to the end user, but it's a whole different thing if you start to do inference and you need that instant feedback loop and reaction. So you need fiber, you need a dense network, you need towers, you need small cells. So there's so many opportunities within infrastructure. And then, Paul, the other thing I would say in software, there's going to be winners and losers in software. But companies that we're emphasizing are those that maybe have a proprietary data set. I think that's really important. They are developing AI tools like large language models that are able to use some of that proprietary data. They automate certain workflows and in some cases completely sort of substitute what a human may do in that situation. So, it's definitely a careful selection approach. But I would say so many of those companies, AI software companies, are actually available in private markets, much more so than what's publicly traded today.
So, we heard that NVIDIA expects to spend $3 to $4 trillion on AI infrastructure through between now and the end of the decade here. Do you have any sort of thoughts about what CapEx looks like right now? What is spending right now in the space, technology more broadly when it pertains to AI spend?
Yeah, well, let's look at the hyperscalers, for example. I mentioned that in 2026, they're likely to spend $400 billion. That's up from 350 billion that we're forecasting for 2025. And that's up a lot from, $100 billion or run rate just a couple of years ago. Now, the interesting thing about that is those estimates have been consistently moved higher. And that, I think, goes back to the point is that demand for AI at this point is really insatiable. And it's because we're starting to see those early signs of payoff. And so, if the question is, do we have a concern about this sort of massive spend on AI? I wouldn't say so, because the demand is just so robust.
All right, let's back away from the AI talk a little bit. Last week, the talk was about the Federal Reserve and what are they going to do with interest rates. What did you take away from Jackson Hole and moving forward here for the remainder of the year? Going forward?
Well, it was probably a strong ever nod to September, as we could have expected from Fed Chair Powell. And, what's interesting is he clearly pivoted to focus on the labor market weakness. And we saw that once again in the conference board, for example. We saw that the labor market differential, meaning the jobs that are plentiful versus hard to get, that continues to narrow. So that suggests that labor market weakness. The other thought that I thought was interesting from Jackson Hole is that while inflation is surely likely to spike in the coming months, they're willing to look through that. And part of the reason for that is because they don't expect it to be sticky. They don't think this is going to be systemic. They don't think it's going to be structural. The reason for that is actually that weakening labor market. And, if you're trying to raise prices into a weakening consumer or into a weaker jobs market, you're likely not going to be successful. And so that's becoming part of the Fed narrative as well. So I think it is a layup for September. I mean, barring just a huge upside surprise on payrolls, which I don't expect, or, barring, I would say, not only a spike in inflation, but a spike in inflation expectations. And I don't think we're seeing that.
Do you agree with that view from the Fed right now? I mean, of course, we know about this dual mandate. It's about stabilizing prices, bringing down inflation, and of course, maximum unemployment. Or maximum employment, excuse me.
Yeah, I do actually very much agree. I do think the inflation story, the tariff-related induced inflation, is a one-time step up higher in the price levels. And I very much agree with the argument that you don't have the labor market strength in order to be able to fully pass through those increases. The other thing I would say, if you look at companies, including our portfolio companies, they're using a mix of tactics in order to deal with tariffs. Some of them are passing through all of the cost increases, for example, in the data center space, because they can. Some of them are passing through partial cost increases. They're working with suppliers to absorb some of those tariff-related increases as well. And some of them are shifting supply chains. So for that reason, I don't think we're going to see a huge spike in inflation as it could have been in the coming months. So that's the first part that I agree with. The second part I agree with is the labor market is clearly weakening. And I would say it's sort of, I don't want to say the precipice, but I'll call it, it's sort of on edge. It's sort of on this edge. And if you tip it over, you're going to tip it over into weakness. If you look at the unemployment rate of 4.2, likely going to 4.3%. If you look at the layoffs, we're just this close to actually slipping into outright potential negative job growth. And by the way, I mentioned that if companies are not passing through the cost increases, what are they doing? They're absorbing that in their margins. So that's why the labor market in turn is again on this edge. So I do very much agree. And I hope we see a rate cut in September. I do also see scope for a couple more this year.
Other than technology, what screens well for you guys these days? I don't know if you do it by industry sector, by factor. How do you guys try to find some opportunities?
We do it by theme and also, of course, by industry sector as well. But when I think about some of the themes that we're excited about is clearly the digital transformation and the many sectors that it touches. We're also investing along the sustainability theme as well. And finally, this notion of new living. The way we consume, the way we take care of ourselves, the way we exercise, the way we live, it is all very different today. And in many ways, it's tech enabled. Further, I would think of it in terms of different sectors within sort of the private market space. And it's goods and it's services, it's goods and products, it's technology, and it's also healthcare, health and healthcare sciences. And so we're finding a multitude of opportunities along all four of those.
Digging into healthcare, because it's the worst performing sector so far this year in the S&P 500. Where are you seeing opportunities there?
Right. So clearly healthcare in the public markets has been at the mercy of what's happening in Washington, D.C. and the policy there. One secular growth in healthcare, I would say, is within pharmaceuticals, and the fact that so many R&D dollars have gone into new clinical trials and new discoveries, and eventually, for some companies, those pay off. That's not actually where we're taking our risks, but rather we're looking at pharmaceutical services that cater to the large or small pharma companies in helping them develop some of those new biologics. So we think the services side of pharmaceuticals is a better risk-adjusted return in order to capitalize for what is a trend in healthcare, which is the growth in the number of molecules that are being created.
Where do you see the just private capital going? It seems like the deal market's kind of picking up, seeing some more, some M&A, IPOs. We've had some really successful tech-enabled IPOs this year. Does that suggest to you that maybe the capital markets are picking up and that could be a driver?
They are actually picking up. And I feel like this maybe is catching people by surprise, because when you look at the numbers year to date, the first half of the year, the M&A activity is up about 30%. If you look at the IPO market, it's up about 21%. And Paul, you're right that it's not just the volume and the number of companies that are, seeking that public listing, but it's also the performance. If you look at the average IPO for a company year to date, it's up 50 or 60%. So it's been successful. Now, I don't think it's an accident that this level of activity is happening. I think public market valuations are interesting to some of those private market companies becoming listed. I think it's increasing consumer confidence and also business confidence, which we've seen quite a turnaround actually since April. And finally, it's, the market is sniffing out a rate cut. And so all of those things are supportive for capital markets activity. So we've seen a very robust first half of the year already. We've actually seen an acceleration in the third quarter as well. So I suspect, especially with a rate cut in September, this should continue.
All right, after Labor Day, everybody, let's get back to work. Anastasia Amoroso, she's at work. Chief Investment Strategist, Private Wealth at Partners Group, joining us live here in our Bloomberg Interactive Broker Studio. We appreciate that. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
John Mowry, he's the CIO of NFJ. They're based down in Dallas, Texas. John, how do you think about inflation, the labor market, and maybe how the Fed should be proceeding here?
So a couple things I would say, Paul. The first on inflation, I think inflation is going to cool. And I'll say that for two reasons. The first is that housing, which is the biggest component, 1/3 of CPI, that should continue to slow. And the reason for that is real-time rents tracked by Zillow are flat to negative. On top of that, as a fundamental bottom-up stock picker, I can see that in the FFO reports coming out of Mid-America Apartments.
Funds flow from operations.
Oh, yeah. That's my thing. I cover REITs, so we always joke about FFO.
Okay. I like that. So you can see it. You can see it in the numbers. So for those reasons, I think that people are underestimating, and that's a 12-month lag. And so that data should be coming out. And you have inventory building and vacancy rates rising. And that's because when rates were low, people built a lot. That all came on the market, and now you have restricted that because rates are high. So there's an imbalance brewing, I think. So I expect that to roll over. And then the second piece is around services, which is a quarter of the CPI. Healthcare is a big chunk of that. And again, bottom-up basis. So you guys have seen UNH, you've seen Humana. Well, a lot of folks don't realize that the insurer portion of that basket, is calculated based on margins, not what you pay the doctor. Everyone says, well, why? Healthcare inflation keeps going up. But it's not based on that. The insurers is based on the margins. Margins have been crushed. So I think that's going to come down, and that's going to give the room a lot more ammo to cut.
So speaking of cuts, market is essentially pricing in a cut in the coming weeks here in September. Is that also in line with what your expectations are? And if so, what's the cadence afterward for cuts?
Well, the 2-year bond yield's been screaming at the Fed to cut for a long time now. So you've got that down there at 3.6 versus 4.5. Let's give a little bit of a sneak preview for what could happen when they start to move rates lower. the Russell 2000 value, okay, on Friday was up just over 4%. You got 1/3 of the entire year's gain of the S&P 500 in a day. So think about that for a second. It's like all year the S&P grind, Nvidia, AI, all these amazing companies. You get 1/3 of that return in a single day just because Jay Powell opens his mouth and says we may need to lower rates. So this is a coiled spring. And to get on another topic just briefly with regard to unemployment, I actually think it's a moral issue that we're waiting to lower rates to see unemployment go up. Because why are we doing this? We have a system that encourages debt. That is the incentive structure that is embedded with how interest is deducted. And yet we're waiting to see unemployment tick up. We're waiting to see people lose jobs before we make borrowing costs lower. And I know that the inflation ghosts of the 70s are haunting the Fed, but I'll be honest, I think it's totally different. With the economy is more globalized, unionization's way down. It's a totally different landscape. So I think we should rethink this entire discussion around waiting for unemployment to go up before we cut.
So what do you think the Fed should be squarely focused on right now? Is the priority here stabilizing prices, bringing down inflation, or maximizing unemployment? Where do you think their eyes are fixed?
I think they're pivoting to the unemployment picture, and that should be the primary focus. To be honest, the inflation picture is already tackled. We're down at the long-term range. The long-term range for inflation is 2.5% to 3%. Going back all the way to the 1970s, that's where it's been. The reality is I have a bit of an issue with this whole discussion because we're talking about the rate of change. Things aren't cheaper. Hamburgers are more expensive and they're going to stay more expensive. We all know this. Cars are more expensive. Houses are more expensive. The rate of change calculation is what they target. And to be honest, the cumulative graph for inflation does this over time. So the idea that we've tamed inflation is a bit of a misnomer. It's just how the calculation's done. But unemployment is the real issue, because if you have people that lose their jobs, that is a real toll on the psyche of Americans. And that's an acute problem that is harder to solve. So I think based on where the 2-year bond yield sits, they should lower rates and they should be quick about it and they should be more dynamic about it. And I think waiting too long presents serious risks to the U.S. economy.
If the Fed is going to be in a rate cutting mode for the next 12 to 18 months, what do you own? What do you want to own?
So I mentioned small caps. I think an area that is just primed to outperform are the regional banks. Let me give a couple comments on this. The price to books for regional banks, some of these are trading back to where they were in March of 23 during the banking crisis. No one's looking at this. Price to books are very attractive. But on top of that, you've got earnings growth in the mid-teens, 15, 16%. Some of these are growing faster than growth stocks. So I'm getting price to books at a discount, earnings growth. And if that yield curve steepens, and it should, they're going to print money. So those look very attractive. They're 20% of the Russell 2000 value. You can't get a small cap rally without the banks. You can't get a value rally without the banks. We've been in a decade growth market. I like regional banks here. I think they're prime. No one's looking. They're growing, big dividends. And the regulation going on with the Basel III requirements for big banks is going to level the playing field more for the smaller and mid banks.
Well, let's stick with another sector that is very rate sensitive as well, real estate. What are you seeing there?
I like real estate, but not all of it.
All right.
Industrial REITs look really attractive. Names like Prologis, Rexford, First Industrial. Couple things on these. They have massive structural tailwinds. I don't know about you guys, but Amazon keeps coming to my house pretty regularly. So those boxes are around the clock. So those need to go through those logistical warehouses and ports. Those are strategic assets. Some of these are trading at the biggest valuation discounts in a decade, namely Prologis as kind of the hallmark company. Very juicy dividend yields. They're not at risk of being cut. The valuations are attractive. Again, no one wants to really own real estate. They're non-existent in the growth indexes. So I like that space a lot. I think there's major upside to these names. And you saw them move big on Friday. and they're a coiled spring. So when do you want to own real estate? Ironically, when capital gets turned off.
So where are you avoiding? I mean, you mentioned that there are opportunities. You're looking at industrial. What areas are you a little bit?
So there are, I would say that, if you look up and down the cap scale and you look to where there are opportunities, I would say that some of the growth areas are priced to perfection. You've got really high multiples, particularly in some of the semi names. I know those names are firing on all cylinders and they look great. Broadcom is an example of that. It's a great company, but you're paying a lot. And so I think that if you look at the market as a whole, some of the technology names are more expensive than I would argue people should pay for those multiples. And it makes sense. The market's at all-time high multiples. But that being said, there are plenty of technology names that still look good. Some of the software names look very interesting to us. Google is a name that we really like here. That's now one of the largest weights in the Russell 1000 value. So that's a value stock. I love how Frank Russell gets to decide what's in and out, but that's fine. But I think there's a lot of opportunity in that name as well. And they've got one of the best teams around quantum, AI, talent, and they're trading one of the lower multiples, tons of cash, buybacks, dividends, et cetera.
Before we let go, what you call in the bond market? Where do you see opportunities, if at all, in the bond market?
Well, I'm an equity guy.
You're an equity guy.
I'm an equity guy, so I won't pontificate there. But what I'll say is I think that the equity income area of the market, namely those REITs, we talked about those banks, if you think that rates are going to come down and you like bonds, then you should really like some of the equity income areas of the market.
Great stuff as always, John. Thanks so much for joining us. John Mowry, CIO at NFJ, giving you some good names there, some good thoughts on some themes there in the marketplace for a Federal Reserve that looks like it's getting ready to cut. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It's time for the famous Lisa Mateo newspaper segment. Lisa, what do you got for us today?
Famous. I'm excited.
Okay, yes, Nora, welcome to newspapers. Okay, so the job market, right? We know for entry-level workers, it's a little bit of a slump, right? But the Wall Street Journal actually has a story. It says, not if you're in AI and you have experience in machine learning. They're saying some of these kids in their, I call them kids, sorry, in their 20s, many of them are making $1 million a year, okay? This is a new report. It says base salaries for even non-managerial AI workers, 0 to 3 years experience, increased by around 12% from 2024 to 2025. And they're also moving to management roles twice as fast as some of the other folks who were just doing regular, software engineers. So there's a company called Databricks, and they said if you have a generative AI research scientist, as little as 2 years experience, they can make a base salary between $190,000 and $260,000 there. And if you include the stock grants, it's even more. So it just goes to show you, exactly how much these students can make when they come out of college having these AI skills and what companies are looking for. It's crazy.
That is so,
I mean, is there an AI degree or is it just, it's so new.
It's very new.
I guess it's machine learning versus software engineering.
Correct.
Because the software engineer, that's been the
it's like the next generation of software engineers.
The next iteration here.
All right. Good.
Yeah. So that's the way to go. I know. Okay. So this one. I just want to say I'm sorry, kids, before we get to the story. A school cafeteria staple in New York City public schools could be disappearing. We're talking about the chicken nugget.
Really?
Guys, this is serious. Okay. No, but the reason why, so there's these new food standards, right? They were announced this week. They go into effect July 2026. It's for like a dozen city agencies, and that includes the Department of Education. So they want to do things like ban processed meats like chicken nuggets, create new restrictions on artificial colors, preservatives, further limit those low-calorie sweeteners, increase offerings of plant protein. So Mayor Eric Adams is saying, you know what, we're going to make New Yorkers healthier. You remember he tried that vegan Friday thing back in 2022. Yep. Didn't kind of work out. He tried it. But a lot of educators are saying, you know what, the kids might not like this. And what if you have those picky eaters? What are they going to eat instead? Because now they're going to be hungry. So it's a battle in the New York City public schools for the nugget.
So they'll just skip out on lunch. You're like, this is too healthy for me. I'm not going to eat it.
I know, because you do have the picky eaters. I know. I had one. He grew out of it. Thank goodness. Okay, I got to go to Cracker Barrel, Paul, for you. Okay.
Oh, yeah.
All right. They went back to the original logo, right? But the New York Post is saying now you have the workers. they're going on social media complaining about the company, right? They're complaining about how much money they're making, their hours are cut back, and they're also complaining about fake home style cooking. So I'm not sure.
Oh boy.
Gas.
Did you ever have the meatloaf when you were there?
No.
You
I've never
did.
had the
Okay,
meatloaf.
I
no.
did.
Interesting. I always get the pancakes.
Well, because you're traveling on the road, right? You're
Right.
at Cracker Barrel. Yay, let me try the meatloaf. Okay, so I did. It was okay. But what they're saying now is because they've been cutting back on kitchen staff, what the meatloaf actually is, it's off a truck, it's frozen, it's prepackaged in these sealed things. So all the basically workers do is they take it out of the sealed package, pop it in the microwave, and there's your home style meatloaf. So people are just like going off about it. They're saying they're cutting back on their hours because they don't have to give them the health insurance benefits if they cut back their hours. But it's this whole back and forth now on social media. The company hasn't said anything about it, but it's this like continuing thing with the restaurant. It's been in the headlines.
Yeah, it's been in the headlines like crazy. The stock is up 18% year to date. A lot of volatility. It's up 50%. Right. We spoke to Mike Halen yesterday on Bloomberg Intelligence. He covers the restaurants for BI. He says this management team's doing a great job. Wall Street loves them.
Yeah.
And
Even pre this whole brand
absolutely.
fiasco.
You can see it in the stock prices. He said they weren't getting younger people.
Right.
The older people that were complaining, or the people that are complaining on social media, weren't the ones coming into the store. So anyway, it's just a different take on what's going on out there. All right, Lisa Mateo with the newspapers. Thank you so much.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.